The Wall Street bull is back in the ring. Fears? They seem to be a thing of the past. Tariffs, trade clashes, the falling dollar, Trump's war with Powell, the government deficit, interest rates, all of it, absolutely all of it, seems to have been left behind. As for President Trump, he's ecstatic. His trade deals are going exactly the way he wanted. He's ticking every box, with the UK, with Japan, with the European Union, with South Korea. Lately, nothing seems to be standing in his way. And that, too, is pure fuel for Wall Street.
Investors have finally bought into Trump's narrative. For whatever reason, right or wrong, they're now convinced that Trumponomics is going to work. The markets, especially in the US, have surrendered to Trump, and now everything he does seems just fine to them.
The result, the American stock market is back at the top, if we measure it in dollars, that is. Because, as you know, Uncle Sam's currency hasn't exactly had a great year. But hey, in dollars, who cares? The S&P 500 is at an all-time high, and that's exactly what American savers are seeing. This is a far cry from what anyone expected just a few months ago.
I don't think any of us expected that we'd end up where we are at the end of the second quarter. What that speaks to is the underlying strength of the US, the private sector, our capital markets.
There's a sense of euphoria in the air. The market's hitting record highs. Many companies have no revenue, but tons of future promises, and their stock prices are soaring. Investors are leveraging like they haven't in ages. And honestly, social media is full of big trades and bold moves. Even short sellers, the bears betting against the market and companies, are starting to disappear.
A troubling sign. Short sellers are vanishing while the S&P 500 breaks records.
And all of this is exactly why we're starting to see headlines like this.
Wall Street euphoria sparks bubble warnings. Analysts point to signs of market froth.
And it's not just headlines, it's also sparking deeper reflections like this one.
I think you're beginning to see perhaps some very early parallels to what you saw back with the internet boom in the late 90s, early 2000s. There's this lottery ticket mentality that tends to exist. It's a dangerous setup.
The bears are in retreat, tech stocks are hitting new highs, Nvidia has surged well past the $4 trillion mark, and growth-focused stocks are taking off. Palantir, for example, is up more than 130% since April, and Coinbase has jumped over 150%. All of this has pushed the S&P 500 to trade at over 3.3 times its sales right now, a record high in its entire history. And let's be clear, it's not just this one metric. Pretty much any other you look at is telling the same story.
Across the S&P, price to sales, price to cash flow, price to book, price to dividends, they're all near record levels.
For example, the price to earnings ratio has already climbed above 29 times. Meanwhile, the Nasdaq is currently trading at a price to earnings ratio of over 40, which is no small number. Like I said, despite all the problems, euphoria is through the roof. And that's led people like Jim Rogers to say things like this.
Jim Rogers sold all his US stock holdings, saying he's seen this party before.
Though, to be fair, good old Jim has been predicting a disaster for years, and it still hasn't happened. Now, look, the truth is, corporate earnings, economic growth, and consumer data are all going strong. We'll get into that a bit more later. But right now, there's an idea that I'd like to throw on the table. There are plenty of reasons to be euphoric, no doubt about that. But more and more professional investors are starting to wonder whether the market's total disregard for risk is actually making those risks even more dangerous. And you know what? Right at this point, Jamie Dimon, the powerful CEO of JP Morgan Chase, the largest bank in the US and widely seen as the voice of Wall Street's financial industry, has had quite a bit to say in recent days. He stepped in to highlight two major risks facing the US economy, and by extension, the US stock market. These, my friends, are the two warnings he's putting on the table. Pay close attention because they are well worth considering. I'll tell you now, the first one might be more predictable. But the second one, you really need to hear. Dimon isn't mincing words. Any attempt to oust Powell could trigger major financial turmoil. It could send government bond yields soaring, cause the dollar to tumble, and drag the markets down with it.
Jamie Dimon warns on Fed independence as Donald Trump piles pressure on Jay Powell.
This is something everyone's been talking about lately. Trump wants the Feds to cut rates, but the Fed, under Powell, doesn't, and the reason is pretty straightforward. The data on inflation, jobs, growth, income, and spending just doesn't support a rate cut. In fact, they suggest the current rates are appropriate, if not already too low. For example, while headline inflation sits at 2.5%, if you adjust for the most volatile components, which is exactly what the Atlanta Fed does to track more structural price trends, you'll see it's actually running above 3%. That's a big shift, considering this same measure consistently stayed below 2% before the pandemic. And all of this is happening before the new tariffs start to have a real impact. So this is essentially why the White House hasn't been able to impose its will on the Fed. Something that's clearly frustrating them more and more. But here's the thing. The issue doesn't stop with the potential ousting of Powell. Trump says he's not planning to remove him, even though he's attacking him morning, noon, and night. No, the bigger problem is that Powell's term is about to expire. It officially ends next May. So what's the concern? Well, the next Fed chair has to be nominated by Trump. Let's just say there's a good chance that whoever he picks won't exactly be the most independent-minded person. Trump knows exactly what he wants. Someone who will cut rates, let the government spend more freely, and pump as much fuel into the economy as it takes, no matter the cost, because his strategy is crystal clear.
There's one thing about Trump that excites the markets more than anything else. He promises them money, lots of it. He's completely ditched his original goal of fiscal discipline and has fully embraced the no-limits party of government spending, unlimited debt, and endless monetary expansion.
In other words, to carry out his plans, Trump needs a Fed chair he can keep firmly under control. And naturally, the timing of the appointment is perfect for picking someone who's, let's say, compliant. The problem is, this could cause serious trouble down the line. In fact, this is another clear warning from Diamond, because according to him, if Trump doesn't appoint a credible successor to Powell, both stocks and bonds could take a sharp hit.
Playing around with the Fed can often have adverse consequences, the absolute opposite of what you might be hoping for.
If the Fed cuts rates, it could end up overheating the economy and triggering a full-blown inflationary spiral. Keep an eye on this. It's going to be a major topic in the months ahead. But this isn't the only warning Jamie Dimon has for us, so listen closely. The head of JP Morgan Chase says we're witnessing the early stages of what could become the next financial crisis. Private loans to highly indebted companies. What's popularly known as shadow banking, a sector that's exploded in the US in recent years. Diamond says the whole situation reminds him, in some ways, of the subprime mortgage madness that ended up triggering the 2008 financial crisis. Ironically, JP Morgan itself has recently announced major investments in this very space. The private credit boom really started heating up around 2015. That's when the giants of private equity, armed with hundreds of billions from pension funds and elite university endowments, decided to dive into a new playing field, corporate lending. Their goal? Simple: chase higher returns. The result? In just 2 decades, this market has grown 100-fold, and by 2024, it was already moving over $700 billion. In other words, giants like Blackstone, Apollo Global Management, and KKR suddenly started pouring tens, even hundreds of billions of dollars into this market, lending to companies without having to follow the strict risk regulations that traditional banks are subject to. More risk, yes, but also higher returns. According to a recent Fed study, companies pay, on average, 2 to 3 percentage points more for these types of loans. That extra yield is attracting even more capital into the market. So much so that this shadow lending sector is now going toe-to-toe with traditional banks. Now, according to Diamond, behind a lot of these financing deals are the very forces fueling today's market euphoria. Corporate takeovers, major investments, and even stock buybacks, funded with borrowed money that comes with far fewer strings attached than bank loans. This raises 2 major concerns. First, this process could be inflating a massive asset bubble. And second, even though default rates are still low for now, many economists warn that this could flip fast if we hit a prolonged recession. If that happens, this whole channel of financing could dry up overnight, and that could cause serious trouble. Again, this isn't just speculation. It's exactly what Jamie Dimon is warning about, the potential seeds of the next financial crisis. And we can sum it all up pretty clearly. Beware the euphoria, and especially the companies that are heavily reliant on borrowed money just to operate and grow. And beyond these 2 major warnings, there are, of course, a few more risks worth mentioning. Donald Trump is scoring big wins on the trade front, political wins. Here at Visualeconomik, we've already shown you how he's mercilessly steamrolled Ursula von der Leyen's European Commission. But here's the catch, these wins aren't necessarily good news for the US economy, because at the end of the day, tariffs are basically a tax hike. And get this, according to estimates from Goldman Sachs, over 70% of the cost of those tariffs will fall on US consumers and businesses. That, logically, could mean higher prices, less purchasing power, and trouble for many businesses. Historically, tariffs have never really been a great idea. So when you combine Diamond's two major warnings, the Fed being politically manipulated and the unchecked growth of private credit, with the impact of tariffs and any new chaos stirred up by this White House, you get a recipe that could potentially trigger a shift in a market that already looks seriously overheated by most metrics. For now, the market has bought into Trump's plan. The real question is, how far will this euphoria go? The good news, corporate earnings are solid. S&P 500 companies are maintaining strong operating margins, energy is cheap, and we're right in the middle of a full-blown tech revolution. In other words, the fundamentals seem solid, but let's not kid ourselves. Markets never move up in a straight line. When euphoria goes too far, a correction always follows. There are two key things to keep in mind here. First, the current dynamic is pushing market concentration to historically high levels. The big stars are taking up more and more weight, and their valuations keep climbing. This chart clearly shows how market concentration hasn't just increased, but how the multiples on these companies have also expanded significantly. So what does that mean? It means that if something goes wrong, those big names could be the first to take a hit and drag all of Wall Street down with them. Which brings us straight to the second point. There's a classic piece of market wisdom from Warren Buffett. Be greedy when others are fearful, and be fearful when others are greedy. And let's be honest, right now, euphoria is everywhere. And when that happens, it tends to concentrate on a handful of stocks, while large parts of the market get ignored. This cycle usually continues until the so-called smart money kicks off what's known in the industry as a big rotation. That's when investors start moving their capital out of the hottest assets and into other companies or sectors that are trading at lower valuations. And that, right now, could be exactly what's about to unfold. So keep your eyes open. The fundamentals may be solid, but valuations might be running too hot. The good news, that also opens up a lot of new opportunities. But with that said, here's the big question. What's your outlook on the market? How do you think things will play out for the rest of the year? Drop your thoughts in the comments and let's open up the discussion. And if you found this video interesting, don't forget to give it a like and subscribe to Visualeconomik if you haven't already. Take care, and I'll see you in the next one.